Hello and welcome to Partnership Formation Part 2. The focus in this video will be page 10.4 in your book. Virtually everything on this page is important and is going to be either on the quiz or going to be on your next test. Okay, so let's take a look at this whole page. All right, at the top of the page it says a partner's original basis in the partnership interest is equal to the basis of the property transferred plus cash contributed to the partnership. Okay, so we just mentioned that in the previous video. All right, if you're transferring in cash, okay, then your basis is the amount you are transferring into the partnership's account. If you're transferring in property, plant, and equipment, all right, your basis basically, all right, assuming that it hasn't been depreciated, your basis basically is what you paid for it. The fair market value of the property is immaterial, okay? It's what you paid for it, all right? If you are transferring services, okay, then you are transferring in services equal to basically what you would have charged. Okay, you know, had you been a third party and the partnership would have paid that third party for their services. Okay, all right. So the important thing is whether or not there is any gain. If you're transferring cash, there is no gain. If you're transferring in property, plant, and equipment that is not subject to any kind of a lien or a mortgage, okay, then there is no gain. All right. If you are transferring in services, okay, all right, there is gain for the entire amount of the services, all right, because there is no adjusted basis to services, so you are reporting a gain equal to the amount of the services rendered. All right. Once you have established your original basis, okay, then your interest and your basis in the partnership is increased or decreased by what occurs after the partnership is formed. Okay, so let's take a look at the first example on page 10.4. It says Prentice contributes cash of $50,000 and property with a fair market value of $110,000, adjusted basis of $30,000, okay, to the P&H partnership. So what this means is that Prentice basically paid $30,000 for a piece of property that is now worth $110,000. All right, so it has a built-in gain of $80,000. All right, okay. You ignore the $110,000 figure, and Prentice's basis in the partnership is the $50,000 of cash and the adjusted basis in the partnership asset that he contributed, all right, of $30,000 for a total of $80,000. Excuse me. All right, assume that the excuse me, I have something in my throat. Okay, assume that Prentice also provided $15,000 worth of services. All right. Well, that $15,000 of services would be reported as ordinary income on line 21 of his Form 1040 for that year, and because he's being taxed on that $15,000 in the current year, he gets to add that to his basis in the partnership for a total of $95,000. Okay, then you have example number 2. You got Darnell. Okay, Darnell contributes property with a fair market value of $110,000 and an adjusted basis of $30,000. Okay, so that means he's bringing in a piece of property worth $30,000. Okay, and there is a liability or a mortgage on it of $20,000. Okay, he is going to receive a 25% interest in that partnership. Okay, so basically what you do is he gets credit for all of the $30,000, okay, and he looks at it and goes, okay, you know, what am I giving up? $30,000, right? Okay, what am I getting? Well, he's off the hook for 75% of a $20,000 mortgage. He's still on the hook for 25% because that's his partnership interest. So you take 25% of 20,000 and subtract it from the 20,000, or take 20,000 times 75%, and that's what he's getting because he's off the hook for that much liability. Okay, so he's off the hook for a total of $15,000. He's contributing a property worth $30,000. So take the $30,000 piece of property minus the $15,000 he's off the hook for. Okay, and then his basis in the partnership is $15,000. Okay, all right. The next paragraph is extremely important. Okay, and you need to highlight, all right, because that will appear, in either word form or in amount form, okay, on the quiz and on the next test. Okay, so the basis of a partner's interest in a partnership changes due to partnership activities. These are things that occur after the partnership is formed. A partner's basis in his or her partnership is increased by their share of additional contributions, number one, net ordinary taxable income of the partnership, that's 2, any capital gains and other income, we'll talk about in the next video, okay, excuse me. Alternatively, their basis is reduced, but not below 0, of the partner's share of any distributions of property back to the partner, and any losses from the operations of the partnership, and any capital losses or other items and other deductions of the partnership. Excuse me. Okay. If you take a look at the example, all right, fourth example on page 10-4. It says Reed has a 50% interest in the Reed partnership. Her basis at the beginning of the year was $12,000. Okay. For the current year, the partnership has ordinary income of $15,000, a capital gain of $3,000, and charitable contributions of $700. Okay. All right, so the first two add to her basis. The third one subtracts from her basis. All right, so her basis then would be the original 12 plus half the 15,000, half of the 3,000, minus 1/2 of the $700 charitable contribution. Okay, so at the end of the year, Reed's partnership basis is $20,650. Okay, there'll be a quiz, there'll be a final exam question involving that. I shouldn't say a final exam, the exam over chapters 9 through 12. Okay, and then finally, the last thing on page 10-4 is what is the partnership's basis in all of this? All right. Up to now, we've just talked about the partner's basis, okay? The partnership's basis on property contributed is equal to the partner's adjusted basis on the property, okay, at the time of the contribution, plus any gain recognized by the partner, okay? All right. The transfer of liabilities does not impact the basis of the property to the partnership. So if the partner brings in a building with an adjusted basis of $100,000, which has a mortgage on it, that doesn't matter. That mortgage affects the partner's basis in the property, but does not affect the partnership's basis because the mortgage is a liability. Okay, it's not part of an asset. All right, and that's one of the things it's not that hard actually if you know a little bit about financial accounting, and if you T-account this stuff, you can see it real easy. Okay, so the asset itself comes in at its adjusted basis, and is recognized as such for the basis in the partnership. All right, not the partner. Okay, so take a look at the last example on page 10.4. It says Clark contributes property to the Rose Partnership in exchange for a partnership interest. The property contributed has an adjusted basis to Clark of 45 and a fair market value of 75. The partnership's basis in the property is $45,000. Okay, all right. Okay, in the next video, we're going to talk about pages 10.5, and then we're going to look a little bit at Form 1065 and Schedule K1, okay, which are on pages 10.7 through 10.14.